Hey there, everybody. My name's Shane. I run the events over at 10 Capital Network. We have another great one for you today. Our 10 Capital Quick Pitch with a special presentation at the beginning from Sarah Jennings of Beyond Angels. We'll get to that in just a sec, but just want to remind everybody in the audience, if you have any questions, you can drop those in the chat box during the session. We'll do our best to get to those. Also, we'll be running polls throughout the session for the companies we'll be hearing from. So be sure to answer those as well, and we'll get back to you after the session with follow-ups. So with that, I'm going to hand it over to our CEO, Hall Martin, to get things started.
Great, Shane. Thanks for setting this up, and I want to thank everybody for joining us today. Those in the audience, looking forward to your feedback in the chat box as well. And one of the questions we get asked a lot is, how do angel groups work? We spend a lot of time explaining that. And so we decided to invite Sarah Jennings of Beyond Angels to come in and talk to us a little bit about how her angel group works. Sarah, thank you for joining us.
Hi, Paul. Thank you for having me.
Well, great. So let's kick off, and maybe you can tell us a little bit more about yourself and your group and what it's all about.
Yeah, happy to. So we are an angel network based here in Dallas, Texas, so just up the road from Hall in Austin. And we focus on investing in technology companies, starting in seed stage investments through all the way to Series C. We invest post-revenue, so that's a little bit about our investment thesis as well, too. We also are a network of affiliated angel networks that are associated with universities. So we also work with universities to help them launch alumni-specific angel networks for their alumni and friends and family of their universities, and help them launch entrepreneurship programs at their school as well, too. So it's a little bit about us that makes us a little bit unique. We host events throughout the year. We have pitch events. So we have 5 this year. We've had 2 already and 3 upcoming. So about every 2 to 3 months, we host a pitch event for our angels and also for the investment committees of our 2 funds that we have as well, too. So at those pitch events, we have typically 3 to 4 companies that pitch live that ultimately tend to receive investment. So while no investment, we can't guarantee it. Historically, everyone who's pitched has received funding from our angels and our funds, which is really exciting as well, too. We are based here in Dallas, like I said, but we have investors across the United States. And so we host hybrid meetings across the United States as well, too. So every pitch event is hosted at a different location in person to give others the opportunity to be in person. And then we have people that Zoom in as well, too. So that's kind of a unique component of what we do, given that we're not just one geographic location. Since we're across the United States, we like to give the opportunity for all of our investors to have that in-person interaction with the companies and fellow investors as well, too.
Well, you work with a number of universities as well. What's your relationship with them?
Yeah, so like I said, we have members that are universities, and we help them do a number of things that they kind of can pick and choose what they want us to help them with. But we help them first and foremost launch their own angel network for their university. So we help them, building things from the operational standpoint, from the deal flow standpoint as well, too, and ultimately having building more syndication partners for all of us across the United States, right? To have more angel networks to share deal flow with and to be able to co-invest alongside. We also help the universities launch entrepreneurship programs for their students. So that could be from an academic standpoint with curriculum for entrepreneurship classes, or it could be from a student startup accelerator standpoint as well, too. It's really up to the universities what they'd like to do. We've done it all, and so we can help them depending on whatever their goal is for, providing more entrepreneurship activities at their university.
Great. You also have a fund. Can you explain what that is and what the investment thesis is there?
Yes. So we have 2 funds right now. One is in the last, probably about 6 months of deploying capital, and the second one just started deploying capital at the beginning of this year. And both funds invest in early stage venture investments. So again, investing starting at a seed stage all the way through to about Series C. We will go as late as that for the right opportunity, but most of our investments are in seed and Series A investments. Technology across the board. So we've done some hardware plays, but we've also, of course, do a lot of SaaS, as you can imagine, all post revenue and in various industries. And for us, when we're looking at a deal right now, what we're kind of really trying to focus in on are opportunities that we feel like are really disruptive to the current markets that they're in, or if they're creating a new market, that's great as well too. We also like to see an exit within about 3 to 5 years for a timeline horizon. It's kind of what we look for on the exit timeline. So typically a company is about probably about 18 months out from profitability when we invest. It's kind of our timeline as well there. So we'd like to invest right before they kind of hit the inflection point as they're scaling and growing. And then of course, with the funds, we have as a strategy to have a number of investments or a portion of the portfolio in some later stage opportunities like Series B or Series C investments to help diversify the fund from the exit timeline horizon as well too.
Great. And so how do you source deal flow? Where do you find the best deals?
So that's a great question. So we source deals through a number of ways. I would say the primary one where we find our best deals are from our deal flow kind of referral partners. And those range from other angel networks. They could be accelerators, other funds, just other really connected angel investors, and then other programs like 10 Capital. So obviously 10 Capital is one of our favorite sources of deal flow for us. And so people who know us really well, including organizations like 10 Capital, are how we find our best deals. They know our investment thesis, they know what we tend to like to invest in, and are able to refer deals over to us as well that are a good fit. We also find others just by, going to events and being out in the marketplace and things like that. But how we find and source the majority of our deal flow and our best deals are through our relationships with our syndication partners.
And what's the process after someone comes in and submits an application? How's the deal flow process cycle forward from there?
Yeah, so for the angel network, what we'll start with is, we're going to review anything that's submitted. So a pitch deck, or if there goes through an application, we'll review all those items. And then we'll host a really short, just introductory call. So a 30 or 45-minute call where we just want to get to know the founder and company a little bit. Let them also have the opportunity to get to know us too, and explain our process and what we're looking for. And also try to ask maybe the top 2 or 3 key questions we have at that point in time that we would need to have answered to be able to know if we want to move forward with due diligence. So after we have those calls, we then select maybe our top 10 or so companies that we want to go through due diligence with. We'll then bring in one of our analysts and also one of our investors who has relevant industry experience in that particular industry to help us evaluate that deal alongside the rest of the staff. And so we go through data rooms and we do our research. We set up about a 1-hour due diligence call with the company to get started and to start going through our questions that we have after going through the data room and doing some due diligence. And from there, it's just a little bit of a back and forth, but not too much. We try to keep it really efficient. So 1-hour call, most of the time, a lot of our additional due diligence can be done through email with questions and answers, or we'll just set up another call if we need to as needed. Once we get to that point, we put together our own analysis decks for our investors, and we have them vote and force rank the companies that we've done due diligence on to select who they want to see come and pitch live. And so those top 3 or 4 companies are who we invite to our live pitch days. They pitch, and then on pitch day, we actually collect soft interest from investors and from our 2 funds as well too. And from there, that starts the post-pitch process. So the post-pitch process typically takes 30 days or less. That's for us to have our investors complete their individual due diligence, the funds complete their due diligence, and then make an investment decision and execute the investments.
So what exactly are you looking for in the diligence process? What are the key elements that you want to see?
Good question. So for us, we want to really dig into kind of customer revenue pipeline, the financials, both historic as well as, pro forma and going forward, their plan to scale. Also, we really like to look into and learn more about the management team. We really want to understand who's running the company, who's leading the company, their background, and also, advisors, et cetera. And then we also really dig into the exit strategy as well too. And again, we'll do a lot of our own analysis and on that to see what we feel like is potential investment returns for our funds and for our investors.
And then after you fund a deal, how do you syndicate that out to other groups?
Yeah, great question. So we do this a number of ways, and it really kind of depends on our syndication partners, how they like to operate. But a lot of the times what we do is we'll, say we've invested in the deal, we'll take the deck to one of our syndication partners that we feel like it's a good fit for. So we kind of know everyone's investment thesis, and we'll say, hey, here's a company we just invested in. We're really excited about this company. We feel like it's a great opportunity. We believe it's a good fit for you. Do you have any interest? If they say yes, then we facilitate an introduction between the company and the other investor or the other group or fund, whatever it may be, and help them get that connection going. And then, of course, as that other fund or group or investor has questions, we're often able to help answer some of those questions from an investor's perspective as well, too. So it's something we really like to do for our companies. If we're not the last in capital, we want to help with introductions and try to help them close out their rounds. And also, as they raise subsequent rounds, help them get introduced to the right investors at that point too. So we have investors that go later than us, who can lead rounds later than us and all of that as well too. More growth stage VC all the way up to private equity. And so as our companies raise subsequent rounds, we also try to make those introductions to help them find future lead investors and other just investors in the future as well too.
And how many rounds of deal flow do you do a year?
So for the Angel Network, we do about 5 rounds of deal flow a year. So basically 1 per event cycle. The funds are always looking, right? So the funds, that deal flow cycle never stops. You're always looking for an opportunity there. But the network, with it operating on a pitch event basis, is about 5 a year. And again, those cycles last a couple of months long typically. So a couple of months for, sourcing deal flow, and then going through due diligence, and then about a month to wrap up. So the longest someone is typically in our pipeline before they get an answer, if they are someone that makes it all the way to the final pitch and then is invested in, is about 2.5, 3 months tops. Some of them can be as short as 2 if we got them in last minute right before our pitch event and it was kind of a short and really kind of rushed due diligence. We can do that, but quick timeline would probably be 2 months on the short end, but really about 2.5 to 3 months for our full cycle for both the Angel Network and the 2 funds. So we have about 50 investors in our Angel Network, and then we have the 2 funds. So about 2.5 months to go through the one process for 50 investors plus 2 funds tends to be, I think, a pretty good use of time for most entrepreneurs.
And where does the fund fit into the deal flow cycle? Is it at the end or during certain parts of the year? How does that work?
Yes, so the fund comes and attends all those events. So they use the events as a source of deal flow. We have some companies the funds invest in that we call off cycle. So somehow, the timing just doesn't line up right with a pitch event. So there's a really great company, but it's not going to line up with one of our pitch event cycles. And so the funds can then just take a look and invest off cycle, like we would say. So the fund will invest 12 months out of the year. They're always looking, but they certainly utilize the Angel Network events as an opportunity to see at least 3 or 4 deals all at one time, right? And because some of the investment committee members are often involved in the screening and due diligence prior to the pitch, they're often already somewhat up to speed with what's going on with the company, and again, can fit that 30-day or less timeline on the back end of the pitch to wrap up and make an investment decision.
Great. And for the accredited investors in the audience, how can they join the group? What's the process like? What's the fee, and how does that work?
Yes, great question. So for the Angel Network, it's a pretty simple process. So you can learn more on our website, but it's just an annual charitable tax deduction for your membership. So we're a 501c3 on the Angel Network side, and we're structured that way so that way we can provide educational opportunities for our investors, for our entrepreneurs, and for our students as well too. And so that's just an annual membership fee. You get the opportunity to come to all of our pitch events, all of our social events, our annual meeting, which we host on the beach in Florida. So it's pretty fun. I'm not going to lie. You'll want to be there, get to see the CEOs and meet fellow investors, enjoy a break from winter. And then on the fund side of things, of course, right now, we don't have an open fund at this time, but the funds are typically raise a new fund about every 12 to 18 months. We're on an annual fund, kind of about an annual fund launch timeline. So I'm looking to probably launch one at the end of next year. And at that point, it's just the simple, joining that way as well too. But the Angel Network is very easy. There's an online form you can fill out if you have interest in learning more. And there's another form online on our website you can fill out if you'd like to go ahead and join, and we can get connected with you and help you with the next steps. But love to get to talk with anyone who has interest and answer any questions that anyone has.
Great. We'll put your contact details in the chat box along with your web link there, or if you can put it in. That way people can get back in touch with you from this session as well. But want to thank you for sharing that information with us. And then hope to have a good session here as well. So with that, let's bring up Vadim Balashov of Viaduct Ventures. For those in the audience, we have two investors on the panel. You've already heard from Sarah. We'll now hear from Vadim about what his fund is all about and what they do. And then just a quick introduction there. And then we're going to have 4 presentations. They'll each get 15 minutes. And the questions initially will come from those on the panel. If we have time, we'll answer those from the audience as well. So Vadim, if you're available, go ahead and let's hear from you a little bit about your group.
I'm Viaduct Ventures, California, Series A VC. Our primary focus has been artificial intelligence, and this is not the past 5 months, this is the past 5 years. We did not just jump on the bandwagon. SaaS, cloud-based, enterprise SaaS, business improvement of business processes, improvement of revenue processes for our enterprise clients. I am based in Europe, and I work with investors, but also primarily with the pipeline and the first investments. The first meetings with startups is what usually falls on my plate. My partner Stuart Gunther is in Menlo Park, California, and he works with our investee companies through their growth stage and our harvest stage when they exit. And I'm currently in Bethesda, Maryland, on my way to California.
Great. Thanks, Vadim. And with that, let's go and bring up our first presenter. We have Chris Casper of Techless. Chris, if you'd like to go ahead and launch your slides, we'll kick it off. And you'll see the timer up there. He has 15 minutes to pitch and answer questions. So we'll kick it off from there. Again, if you have questions in the audience, let's put that in the chat box.
Awesome. Sounds good. Well, first, Sarah, it's good to see you here. Just so you guys know, from the entrepreneur side, it's been a joy working with Beyond. They're efficient, professional, and have been a blessing to me. So just an endorsement on that side. Secondly, I had a baby this weekend, so my 5th son was born. So I'm excited to take a very quick break to come talk to you guys. But I'm in La La Land, it's celebrating that. But that's not why I'm here. I'm here to talk to you about Techless and WisePhone. And so I'm going to dive in, give you a high-level overview of who we are. But there's a lot more information. Happy to hop on a call after this with you to unpack more. So, high level. Techless is here to create, and I would say define, what healthy consumer technology even is. We are on a quest. We believe in the next 10 years, we can give the world back 100 billion life hours. These are hours that would have been squandered on screen time, watching cat videos and makeup tutorials, and giving that time back for people to wonder, live, imagine, do the things that actually matter in their lives. This whole thing started when I had foster kids. I had 4 kids. I don't have them right now, but when the caseworker dropped them off, she said, don't let these kids near anything that looks like a smartphone. And so I wanted to make a healthy phone for kids, but quickly realized that the kids issue was sort of the tip of the iceberg. Right now, Deloitte study last year, 164 million Americans want to cut back from their smartphone usage, and most of them are not succeeding. Going back to the kids, it's really a serious issue. I mean, since the invention of smartphones, teen suicide rates, direct correlation, have quadrupled. There is a tragic toll on the attention of us right now at this moment. Most parents are worried. 96% of parents, we did a survey of over 2,000 parents in early market research. Everyone's worried about the content on these devices. So we have to ask ourselves this question: why doesn't big tech just snap their fingers and solve this? Apple, Google, they could fix this very quickly. And the reason why is that they're trapped. They built their companies on the attention economy. This is the revenue that these companies are making on their app stores explicitly. This is the money that they make off of our eyeballs on a screen, and they cannot change their business model. It would be illegal for them to change their business model. The shareholders would revolt. And the truth is that they're losing the battle long-term because of this. If you look at the consumer trust scores of these companies, they're declining on the regular. So what needs to happen? A new company needs to come in, set a new stake in the ground from a drastically different perspective. So we created WisePhone. It's a pure and simple phone. It can call, text, has a few basic tools on it, but what's more important is what it doesn't have on it. We are selling boundaries. This device does not have social media, anything you can be addicted to, distracted by, access to pornography, games, entertainment, the things that are sucking our lives away on our smartphones. It's a collection of 7 independent apps we built from the ground up, and there's a back-end portal where you can see robust statistics about what's going on. Everything on the phone is actually being tracked. So it's a perfect tool for parents, but it's a great platform that we have the opportunity to build on. The cool thing is we've been selling WisePhone. We're post-revenue. We've been selling for 18 months now. We interviewed a bunch of customers, 30 customers in depth. We're talking 1.5 hour+ interviews, and consistently people loved what WisePhone was not. They liked the boundaries. They liked the simplicity. They liked the user experience. But what I got really excited about is that we are actually accomplishing what we set out to accomplish, which is that we are transforming their lives. The people that use WisePhone have feelings of peace. They have less anxiety. They have feelings of freedom, and they are happy about this transition in their life. And it is a drastic transition for them. It's not an inch deep. Quick quotes. We've got quotes from moms, dads, husbands, wives, kids. All of their lives are being transformed. Quick data point, the top right quote. I think it's exciting that WisePhone has emerged as best in class in the minimalist phone category. So there's a few other phones that don't do a lot, but we are, if users use them all, we're the one that people like out of all of them. You could go check out our reviews. There's hundreds of them talking about how people like WisePhone, but one of the things I'm super proud of is we're doing this, and we're doing it without compromising on long-term vision here. Our customer success rate, we're talking 99.97% customer satisfaction rate on customer service calls, emails, chats. We're doing really well. And I think the best predictor of long-term success of a company, in my opinion, something you can't fake, is Net Promoter Score. So those of you familiar with Net Promoter Score, goes from -100 to +100. It measures the strength of a company's brand, and our brand is scoring at a 61. This is better than Chick-fil-A, Google, Target, on par with Apple. This is benchmarkable long-term projection of the success of Techless, where we're going. That being said, we're still early stage. I said we're post-revenue. We've sold 3,500 phones so far. That's not a lot in this category. We consider this our sellable MVP prototype. It's good enough to where we could sell it, but we have so much more that we want to accomplish. And what I'm excited about is what we've done this with. WisePhone is a $10 million plus project, and we've done it for $2 million, which I think is a testament. If you talk to Silicon Valley folks, this is a really impressive accomplishment, the amount of traction we've got for the amount of investment that has come in so far. So we start with WisePhone 1, but I think if many of you guys sitting in the audience are looking at it, you're like, could I use this device? The reality is that the inconvenience hurdle is fairly high to this. It is a minimalist phone. It doesn't do a lot. We had some supply chain logistical challenges. It's a Motorola device, nothing insurmountable, but there were some hurdles associated with our current model. And so we're at this really exciting inflection point. We just actually this week went live with our pre-order page for WisePhone 2. We've taken everything we've learned from WisePhone 1, and we're working on building it into the next gen phone. And what I'm excited about is there's a fundamental shift from minimal to healthy. This phone is much more functional, much more capable. We're going to have very carefully curated third-party tools on it. And as a result, less than 1% of America was interested in WisePhone 1, 30% of America or more is interested in WisePhone 2. In addition, it's custom hardware, it's branded, we have greater control, and we have a 2-year manufacturing contractual lifespan on this thing, which is unheard of in the industry. So very excited about that transition. Additionally, a couple big high-level financial metrics. We went from a $400 $400 total lifetime value of a customer and decent margins in the hardware space to now over $1,000 lifetime value per sale and quadrupling the profit margin on these two sales. So people say, hey, what's out there? The truth is there's not a lot that's comparable. We consider Wise Phone 2 a blue ocean category creating device. It is the first healthy phone out there. Currently, there's other minimalist phones. However hard Wise Phone is to use, other minimalist phones are much more painful to use. E-ink screens, they're just hard. People think they can lock down a smartphone, but I think we're starting to realize that if you put your phone in night shift mode, or you cut off this app or delete this app, you just reinstall it again. And it's like McDonald's offering healthy choices. It doesn't actually solve the root level issues. There's a few kids phones out there. The truth is kids don't like kids phones. We talked to a bunch of them. And so we intentionally made an adult looking device that is safe for kids. And that's about 30% of our market right now. Privacy and hacker phones, not many people want them. They're all over $1,000. And flip phones are a hassle. T9 texting isn't great and there's no controls. We're also just kicking off an experiment, Wise Phone for Business. No promises here, but we're looking at $1,000 per year as an option where people could have a phone for their employee with unlimited texting, calling, and data that's locked down, walled garden, liability prevention. I had an IT director a couple of weeks ago tell me if we had this last year, it would have saved us $250,000. And this is a 300-person company. So there's something here, we're sniffing it out. A little bit about me and John. We're kind of the core team. I have built brands. I'm a marketing guy through and through. One of the companies I worked on, about 7 years after launching, crossed $1 billion in lifetime sales. 10 years after launching this last year, we just crossed 900 million for this year alone. And that was a company that I established the branding and marketing strategy for. Jonathan has similar traction at Google, ex-Google guy. He built a product for Google in the A/B testing space. Year one, launched it, brought in over $1 billion in revenue. So both of us have done this before on larger ventures and just kind of taking that expertise here. Not going to dive into the details, but we have an exciting plan over the next 18 months to 4x revenue fairly quickly. Again, worth a further conversation. And high level, here's where we're gone fundraising wise. So we raised $500,000 friends and family. The last round we raised, we were looking for $700K, and literally 2 weeks before the round closed, we had another basically doubling our commitment, and it had 1.5 million come in, which was just such a cool moment. And so right now we're asking for $1.5 million at this time. It's a convertible note, fairly straightforward, simple terms. And so as you're thinking about Techless, where do we fit in the whole world? At the end of the day, there's a lot of people talking about social media and regulation and AI and all the harms. But the truth is that very few people are talking about the solution and very few are actually building the solution. We're one of those few. So we would love for you to join us on this journey.
Thank you, Chris. And let's have the first question go to Sarah. Sarah, what's your first question?
Hi, great job, Chris. Thanks for going through all of that. One question I have is just on kind of the retention rate, if you will. So I know I've bought a phone before and I had it for a day and hated it and returned it. So I've been there myself. So what has it been like for your customer feedback so far in terms of, return rate on maybe this phone for people who maybe aren't familiar or haven't used a really simplistic phone before versus your competitors?
Yeah, and I'll say that in our industry, that's exasperated because this is like a personal trainer. It's not something it feels good. It's really good for you, but the moment you get a phone, that was actually the heart behind our detox kit. We launched a detox kit where you rent a phone for 30 days just to try it out, and then you give it back to us. And we actually make money off that transaction. And we did that to let people test the waters. Gizmodo thought it was cool, post an article. The truth is our return rate's around 17%, which is actually industry average in the smartphone category is around 16%. So we're doing pretty good holistically in an extremely challenging category. So
Thank
Great.
you.
And Vadim, what's your question?
How do you scale? 3,500 phones is great. Quadrupling to 12,000 phones is great. What is the annual sales number that is sustainable for a sustainable business, and how do you get there?
Yeah, definitely. So the cool thing is we're selling, historically, we've sold 250 phones a month or so, which isn't crazy. Once we hit 1,000 phones a month, we hit break even, sustainable operation. And at that point, we just pace innovation based on cash flow, if that makes sense. And so we are not far off, I would say, from a sustainable operation here. And then I get to do my job, which is marketing and growth. And we're going after a lot of, there's to answer your question, there's two major ways long term. One is channel partnerships, where we're partnering with, and we have one of these in queue. We're partnering with a group that works with 85 private schools, and they are selling WisePhone to those schools. And so we don't have to directly sell to the individual schools, but partnerships like that, IT outsourced IT companies. And the other one, and this is the big one, is being carrier ready. So we have conversations with Patriot Mobile, and we have already had distribution with US Mobile, and that's where, you know, you get a contract with Verizon or AT&T, and we hit major numbers at that point. So.
Great. And Sarah, did you have another question?
Yeah, Chris, if you could just talk a little bit about your exit strategy, that would be great.
Yeah, that's great. So the fun thing is we actually got an acquisition offer a week ago. So it's it's still in the letter of intent side of things, but basically we're looking for a value aligned complete acquisition in the next, like you said, 3 to 5 years is sort of the timeline. And so being frank, there's a couple conservative political groups that could be a potential acquisition for us because we own the platform top to bottom. There's no Google, no Apple in this thing, and that's highly appealing to them. And I know Dick Blank, the former founder of Beyond Angel Network, mentioned to me acquisition by a larger company, even like Google, possibly. So I'm just mentioning things there. I had a board member mention IPO. I think that's a crazy idea, but it's on the table. But this is a board level discussion. So
Great. And Vadim, one more question from you?
Yes, to get carrier ready and to start to get US Mobile to sell you would be amazing.
yeah. So they've already sold their phones, which is awesome. So
what do you do and how long will it take to get there? And if I may, how many more rounds, how much money overall do you need still to raise until you get to that point?
Yeah, definitely. So honestly, we consider WisePhone 2 distribution worthy. WisePhone 1 has not been something we've shopped around to distributors. But WisePhone 2 is, and like I said, US Mobile has already sold WisePhone 1. And I think WisePhone 2, again, because of the target market increase, will be amazingly carrier ready. And so I would say this round is the final round that we have to raise mandatorily. We hit profitability. There's a chance we might go beyond if the board seems there's value, but that's our final mandatory round.
Understood.
Great. Well, that ends our time here. Thanks, Chris, for the great presentation. Good question, guys. And let's go to our next presenter, which is Howard Bates and Mike Seidel of Pivot CX. If we could go ahead and have Howard load up his slides, we'll kick off with you next and reset the timer. Again, in the audience, if you have questions, feel free to put them in the chat box. We can have time for them. So with that, we see your slides, Howard. Go ahead and kick off whenever you're ready. And those investors in the audience, if you want to vote on TechList, you have the poll in front of you.
Okay, great. Thanks, Hall. Appreciate it. And Sarah, I would echo what our last speaker just said. It's been a pleasure to work with your team throughout some of the due diligence process, initial processes. So you guys have your model down to an art form. So appreciate it. And with that, I'm going to let Mike lead off with us and we'll kind of ham and egg the presentation.
I'm Mike Seidel. I'm the CTO here at Pivot CX. Just a quick look at our leadership team. We have over 70 years of experience in the HR tech space, 30 exits, and one of those being public. We know our space really, really well. So have you ever applied for a job and just not heard back? I mean, you applied, nothing. Well, it's not because the recruiter, it's just not because the recruiter's trying to be mean to you. It's not because they're not paying attention. It turns out that recruiters in HR are spread really, really, really thin. They have to work with an average of 21 different systems just to do their job every day. 60% of the communication they do is missed because they're trying to communicate on the wrong channel. They're sending emails when the candidate expects a text. 50% of recruiting spend gets wasted because no one ever talks to the candidate. And SHRM, the Society for HR Management, reports that 62% of employees cite lack of communication or poor communication as a reason why they left their job. And it's no surprise that 74% of HR and recruiting teams fail to meet business objectives. So here's what really sets Pivot apart from other HR tech companies that are out there. We're creating and leading a new category in work tech, the communications hub. Our leadership team has been around the block and has been successful with over 30 successful exits. And we have product market fit validated with customers like Kelly Services and Great Clips. And most importantly, we're ready to scale. We're competing for a share of the $54 billion HR tech market. That market's projected to grow at 20% per year until 2030. So how do you solve disjointed and ineffective communication that makes your HR and talent acquisition teams log into 21 plus systems every day? With our product, Pivot CX. Our communication hub for recruiting and HR connects with 128 different hiring and HR systems and enables everyone from recruiter to hiring manager to HR to communicate via text, voice, and video. You can replace as many as 10 of those 21 different systems right out of the box with Pivot. And most importantly, we're enabling recruiting and HR to personalize communication at a scale that just wasn't possible before. Pivot's designed so humans and bots and AI can be combined to automate and accelerate common recruiting and HR communication without forcing the customer to change systems of record that they have a big investment in. So if somebody spent a lot of money on a system from Oracle or Workday, we don't want them to change that. We can work with it. Our business model is pretty simple. We're a B2B SaaS company. Most of our customers contract annually and pay monthly. What you see on the slide are really the two price points we sell at. And on average, our orders are bigger than our list price because of the upsells that we have. And to give you an idea, we've been selling our product since 2021, since January of 2021. Here's a quick look at our pipeline. We launched in January 2021. We've managed to get some really, really good logo wins. If you look at our pipeline, it's pretty healthy. There's two sides to it. We sell through a partner channel, which are mostly consultants, recruitment ad agencies, and HR specialists. And then we sell directly to some customers. Let's take a quick look at some of our marquee customers. Community Health is the largest employer in Indiana. They started off with us with a $56,000 prepaid contract for the first year of service. Everybody who gets hired by Community Health has a conversation through a Pivot. That deal is positioned to grow to $89,000 when we renew that this year. Kelly Services, we got our first deal in, and it was projected at $88K of ARR. And I'm pretty happy to say we've been really, really successful with Kelly. As of Friday, they asked us if we would be willing to support them in the Mexico and Canada markets. And so that deal is going to expand. And there's almost unlimited potential for us just in that account. Great Clips, they have 4,500 stores, 750 franchisees. The first year was prepaid at about $320K. We've delivered more than twice the result that they expected. And we still have a couple months left on the contract. We're pretty sure that's going to expand. In fact, we're being asked to look at taking over handling not just the candidates that we were doing through the program we started with, but all of the candidates that go through the Great Clips recruiting system. Our go-to-market strategy is pretty simple. It leverages channel partners and our own direct sales. The channel partners really allow us to grow sales and kind of hitch on to our partners' consulting teams and to their sales teams so we can grow faster. And then our own direct sales allow us to get predictable results. So we keep growing. Just a quick look at some of the competition that's out there. And what you see with most of our competition is they don't handle voice and video and web communication, but they all do text. And we integrate with a lot more systems of record. We actually support 5 times more systems of record than our nearest competitor does. We hook up to applicant tracking systems. We hook up to CRMs. We hook up to HR information systems. And we make it so a company can buy Pivot on Monday, and on Tuesday, they can be chatting with everybody who applies through our platform or calling them or doing video interviews right out of the gate. I'm going to turn it over to Howard and let him give you a rundown of our performance.
Yeah, thanks, Mike. What I like to do is just give you a real quick overview of our performance. So these are some key metrics that I just want to highlight. First of all, if I look at Q1 of last year over Q1 this year, We grew our platform revenues 117%. And that's sustainable. Another key metric here that I think is important to mention is our gross margins are 65% right now. And they really will improve. There's two ways they can improve. Number one was the scale effect. We're still not on a high volume scale, so that will improve there. And a number of our partners are right now telling us to raise our prices. So we can attack that a couple ways. Another one here, I think it's on the slide here. I just want to make sure that we had it there and we weren't missing it. But one of the things from having been involved in a lot of businesses like this in the past, our CAC payback ratio, our number is 2 months. So that really tells us if we can pour resources into this, we can gain customers very cost effectively. And that's a wonderful number to have. The other thing is, if we look at our projections, we projected these out and provided them to a lot of folks, such as Sarah on the call here. We really think that we can sustain over 100% growth rate. We're tracking on that right now. And at the end of 3 years, we see easily achieving 19 million of GAAP revenue with EBITDA of 4 million. But we really would be valued on a SaaS model metric versus that. But I wanted to give you a feel for it. So I think we can execute. I think this is a really great investment for all of us. And maybe next slide, Mike. Make sure we have enough time here. Just to give the investors out here a sense of the exit landscape. What could that look like? So in Q1, 23 VCs invested 2.3 billion in 88 deals. So obviously, even though deal flow right now across the board is probably contracted for a lot of different reasons, that's still a big number. M&A activity, which are some of the really big folks that are out there, 12.4 billion and 31 deals. And again, some of these those are private equity companies, generally speaking, but even some of the big companies that we all know about, like ADP and Workday and so on, did 5 deals and ADP did 8 deals. So there's a lot of traction and activity in this space right now. Last slide here, just to give you an idea what we're asking from potential investors is we've got a target raise of 1.5 million. We really view that as a bridge to our Series A, which we believe right now we'll be able to achieve in Q1 2024. And Mike and I are pretty confident right now that we're going to be able to achieve our operating metric, which would be to get to at least 200K of MRR in that time frame, and that'll open up a lot of opportunities for us if we can achieve that. I think that's probably the key things I wanted to cover on that. The terms of the offering are out there, for folks to see if they're interested.
All right, and Hall, we'll turn it back over to you for questions.
Great. Let's start with Vadim. Vadim, what questions did you have on this one?
Do you use artificial intelligence in this?
Run with that.
Yeah, good question, Vadim. We are in process right now of building out our first round of AI features in our product, and we'll be bringing an AI advisor for recruiters to help them say what they need to say to the candidates better. And then we're really looking at how do we automate the entire top of the recruiting funnel with a large language model AI.
Yeah, Vadim, we actually have the chief on our board of advisors, which if you have a chance, there's some really interesting and very relevant people on that board of advisors. One of them is Doyle Groves. Doyle was the former chief data scientist for Dice, which is a public company, a publicly traded company. And he is a consulting engineer for Twitter and has been doing work with us of late to see how we can really leverage AI. And some of it probably won't be, Bard or ChatGPT-4. We're looking at specific models that will fit a data set around this specific application and potentially a customer's data set, because they're all concerned about privacy. And am I feeding that data into a giant monolithic platform? And I don't have any control over it.
Yeah, and in recruiting and HR especially, there's some compliance concerns that our users have that have to be answered so we can be responsible with.
I understand. On the other hand, it's seemingly all of the B2B AI companies are talking about overlaying the existing business processes, looking at everything that's happening in the existing business processes and systems, reading if you're still using faxes, PDFs, whatever, AI just reads it, understands what's in there,
Absolutely.
and creates a recommendation already made, like 2 buttons: green button, agree with the recommendation, red button, disagree. And so it sounds like AI. It sounds like your direct competitors will
I don't
very
know about
likely
that. I
be
think-
AI based.
I think a lot of the, I think really what we've got is the connective tissue that's needed to make things operate and stay compliant. And I think we'll be able to bring some AI to market that really will make it work for recruiters and for the HR folks. So it just
The
HR tech.
Yeah, the recruiters and HR people could really use what we're kind of considering or thinking about characterizing as really a co-pilot to help them with their job. And that has a lot of applicability for what we're doing. But I know you've been an expert, you've been in this space for 5 years or more. You know, Vadim, we would love to have a off-cycle conversation to get some of your perspective on this,
Okay.
since you've got so much expertise.
Understood. But this, being a co-pilot or being a very useful helper to human decisions is exactly how artificial intelligence startups are, companies are building themselves. So there is a lot. Yeah, there's a lot to be explored there. Thank you.
Great.
Thank you.
Sarah, what's your first question?
Well, hi, Mike and Howard. It's good to see you again. You had a great slide that kind of goes over your competitive advantages over your, other competitors. But could you talk a little bit more about your competitive moat for others coming in and doing the same things that you are?
Well,
We can
I'll
both-
start with that. So one of the things that we've done is we built our product to integrate with existing systems. And what we're finding is a lot of our competitors are highly aligned with 1 or 2 systems of record. And so we've been able to go into places where we can be an alternative to one of these landlocked apps that's stuck because maybe it's highly aligned with an applicant tracking provider or an HRIS. And we're able to connect to multiple systems. So we found that our ability to integrate has really helped us compete. And it looks like it will continue to help us because once we get in the door in these accounts, we become the connective tissue between lots of different systems. And as we connect to more things, we become harder and harder to push out of our accounts.
Yeah, and Sarah, one other thing, and I'd share this with Vadim as well. So we have an open published API. This allows us to really be a platform, and it gives us something that none of our competitors have actually done. I'm not saying they couldn't do that, but it's not a view of the world that they have. And this makes this really very easy with very minimal amount of work to integrate into these existing IT environments. And Mike and I have been around in IT for a long time, and it's one of the biggest challenges. Okay, great. I see this wonderful system, but will it talk to what I've got? Will it integrate? And most of the time it doesn't. And most of the time it takes 12 to 18 months to get it to work. So most of our, I would say another thing that's a really big advantage is speed. So the ability that Mike and I and this team here can integrate with a customer and get them up and running and actually on an ROI basis is 30 days or less. And when they hear that, most customers kind of don't believe it. They're like, okay, we've heard that before, but we're able to do it.
Great. We're at the end of our time. I want to thank you guys for a great presentation and great questions. And now we'll have our next presenter, which is Creative Biotherapies. This is Anita Davidson. If you go ahead and share your slides, Anita, and get ready to kick off when we'll reset the timer.
All right, my name is Dr. Don Davidson. I'm the CEO and co-founder of Creative Biotherapeutics. We're a little different. We're a biotech company that is delivering novel therapies to treat drug-resistant diseases. I'm not Anita Davidson, as you know, so I'm Don Davidson. I'm the CEO. Anita is my wife and the president. Our motto is that we succeed where other therapies fail. So we're raising funding to do our drug scale up and our rat toxicity studies, to do our FDA IND application, and then to follow on to do our first in human phase 1 clinical trial. So what did we do? Well, I invented and patented a first-in-class anti-cancer therapy known as CBT-300. This therapy also works against COVID, which we won't discuss today. So CBT-300 stops drug resistance of recurrent cancer, which is the major problem with cancer therapy right now. Currently, there are no effective therapies for these patients. So the problem, as I've stated, the problem we want to address is recurrent drug-resistant cancer. These are the top 10 cancers in the US last year. Now, there's lots of therapies, and if you're like many people who say there's so many therapies for these cancers, that's true. But if you look at the patients that reoccur, the white lines are the number of patients in each one of these cancers that reoccur. That's the real problem. On the average, these patients have had 7 or 8 different therapies, and there's nothing for these patients in breast, colon, lung, glioblastoma. That's where our drug works. And if you just look at the ones where our drug has shown an effect in mouse studies and in vivo studies, that's over a $21 billion market annually for our drug. Our goal is to enter the market in the second quarter for metastatic breast cancer, which is the line on the left here. So what's our solution? Our solution is CBT-300. I designed it to reverse drug and immune resistance in cancer that has reoccurred. So how's it work? Well, we all know how cancers are. Cancers divide faster. They're much different than all the other cells. You can see the red cells here. But what you probably don't know, and I've spent the last 20, 25 years trying to figure this out, is how they become drug resistant. And one thing I know for sure, and when these cancers become drug resistant, we give them all kinds of toxins, all kinds of radiation, everything. And they become drug resistant, they put this protein on their cell surface. It's a stress protein called GRP78. That's that green triangle there. When that happens, they become very immune resistant, drug resistant, radiation resistant. It's amazing what we give these cells, and they still live. What our therapy does is simple. It just removes that GRP78, that protein on the cell surface. That reverts the cells then to being able to be seen by the immune system. It also allows the chemotherapy, the radiation to work, and we can shrink the tumors. Very simple. So this is our pipeline. We're going to start with metastatic breast cancer. As you can see here, and we hope to be in the market in the second quarter of 26. As you can see, we have been very effective against several different cancers. On the left here is a picture of a very good friend of ours that died at age 49 from metastatic breast cancer. We all have stories like this, but it really tugs at your heart. She had 4 young kids when she died, and it's such a sad story. So the data. CBT-300 is a platform therapy for many different cancers that are drug resistant. Here are 4 different animal studies where we ran head-to-head with Keytruda, which is the standard of care. Keytruda last year made around $21 billion. As you can see in the melanoma, we had a 63% head-to-head comparison with 0 for Keytruda, 75 for lung, and breast cancer, it's about the same. But because these are just single effect dosing, this doesn't have the chemo in it. On the right side, we ran another study with chemo, and our survival rate was around 100%. Doing the same thing. And you can see the tumors in the middle there are completely smaller. And we stopped this at day 24. If we went longer, they'd probably disappeared. But you can see the tumors on the top are the control. Doxorubicin, which is chemotherapy, is on the bottom. When we ran combination, it is very, very small. There's no angiogenesis, there's no blood vessels. Those tumors will die, which we're really excited about. So that competition, yes, there's therapies in metastatic breast cancer, and they're moving into triple negative breast cancer, but it's very difficult to do because there's no target. That's why it's called triple negative. There's no real target. Our therapy ticks off all the boxes between less than 100,000 per year, non-toxic, no resistance. It can work with each one of these different therapies, which will make them better, which we can explain later. Target expression is very high in each one in metastatic breast cancer, and we can work for multiple diseases. So our advantage is we've used our decades of research and expertise and business experience to be able to produce this drug much further, much faster, and less cost. And what do I mean by that? Well, publications show that it takes about 10 people, 10 years, and about $100 million to find the target, to identify the target, to validate the target, find the drug, validate the drug. You can imagine all the steps. Well, because of our experience, we did it with 2 to 3 people in 4 years with $2 million. We're ready to go to the last toxicity study into the IND. We have proof of concept. We've made the drug. We're really ready to go. So we have strong intellectual property position. Our drug is patented. It's kind of a kitchen sink patent. We also tried to cover anything that competes with our drug binding to that GRP78, which we got a claim for. So we have a very strong patent position, and we're now trying to claim other diseases, which we have a patent action right now, which is positive for those. So what are our advantages? Well, if you look at toxicity, everybody's worried about toxicity. So far, because our drug is the same sequence in human, rat, and mouse, and the pathway is exactly the same with all three of those, we see no toxicity as high as we can go in mouse. We're ready to do our rat toxicity. So we don't expect any differences when we go to human because the protein's exactly the same. If you look at efficacy, we've seen wonderful efficacy in animal models. If you look at human testing, we haven't tested in humans yet, but what we've taken is now the thing is to do spheroids, to take the human cells and make these spheroids, which mimic tumors. When we do that in brain cancer and breast cancer, those spheroids completely obliterate. And the research shows that that's about 100% correlative of what will work in the clinic. And finally, we use CROs that are top of the line to do many of our jobs instead of bringing that in-house right now and have too big of overhead. So who am I? Well, I'm Dr. Don Davidson. I have over 33 years experience in drug discovery and drug development. I worked for 25 years at Abbott and AbbVie, and I moved 4 drugs from the bench to the clinic. One of those, venetoclax, is over $1 billion drug. Kinlytic was over $100 million drug, and the other 2 made it to phase 3. My co-founder, Dr. Anita Davidson, has her doctorate in physical therapy. She's ran a clinic for over 25 years. She's also founded 4 successful companies and is a true expert in commercialization and project management. So we have a kind of a decentralized kind of model. We run this and we have CROs that do many of our applications that we need. For one, drug production is done by 2 outside sources that are outstanding. Syneos Health is doing our regulatory and our commercialization, and we have other CROs that are just outstanding. We do know as we grow, we'll have to bring a lot of that talent in-house. So we expect to expand internal staffing in marketing, sales, and finance as we grow. Our return on investments around 22 times. That's once we enter the market for metastatic breast cancer only, not counting other cancers. Our exit possibilities are possible with pharma to partner with in phase 1, phase 2, or even the BLA. We expect that we will enter the market after phase 2 and get a accelerated approval for an orphan drug. Shares can be equity revenues and keep grabbing the equity. And there's possible licensing deals after we get so far into phase 2. So here's what we're asking: $3 million to do our 3-month rat tox and drug scale up. We will then need $7 more million to do our phase 1 clinical study. We have several non-dilutive grants that we have out, 3.5 million. We've already gotten to 1.7, 1.3 million for a National Science Foundation for a grant, and we've gotten seed funding. We do know that we'll need a Series B to complete our phase 2 studies, and then we hope to enter the market after that. So why it matters? Well, we have a strong intellectual property position through 2041. Our investor value, we project at 22 times. We have one therapy for multiple diseases. It's very effective therapy and can help other therapies be better. Our product is safe and non-toxic. We have seen no side effects at very high doses. And our competition, we're so far better. We're superior than our competition at standard of care, but we do believe we will make them better too. So thank you.
Great, guys. Thanks for the presentation. Let's go with Sarah first. Sarah, what's your first question?
Hi, thank you, Don, for the presentation. I really appreciate you taking the time to share more today, and very exciting what you created, and obviously the potential, the impact that it could have on so many people. So thank you for that today. One of my questions was going to be on your funding timeline. So thank you for putting that on the slide with with amounts and kind of key dates and when you think you're gonna need to raise what you need to raise. That was perfect. Talk to me a little bit about this Series A-1. So you're raising 3 million. I see the use of funds there and the milestones reached. What valuation are you raising at, and kind of what's your target valuation to maybe exit at down the road?
I will answer that, but I'll let Nita do it at this point. She has written up most of my pro forma, so I'm gonna let her answer the question.
Thank you.
Okay, so currently our valuation is at $20 million, which sounds like a lot, but we've had some validation from experts based on what our future market potential is, also with the money that we've currently raised with non-dilutive as well as dilutive. And so we're looking then to move forward with the, we broke it into A1 and A2 because the A1 is very critical right now. As soon as we can get that $3 million, we can finish those 2 key studies, and then we can get IND approval, which then improves the valuation and gives additional validation. So at the 7 million raise, then we anticipate, especially after phase 1, we anticipate it going up to 50 million in terms of the validation, or in terms of the valuation. As we move forward toward the clinic, we're looking for potentially, as the one slide showed, a very conservative expectation in metastatic breast cancer to raise a cumulative $2.2 billion in 5 years. And when working on the pro formas, I've got them available. Anyone wants to look at them, but being very conservative with those numbers, starting with mortality. So not looking where everyone else is looking at the earlier stages, which is 297,000 cases newly diagnosed a year. I'm looking at the 43,000 people that die year over year for 30 years. And starting from there and beginning at just 5% up to 25% of the market. So it's very conservative, and even then only dosing for 50% of the year. So we're looking at having that valuation expand significantly at market entry.
Thank you, Anita.
Great. And Vadim, what questions do you have?
Who are the existing investors? Currently, the existing investors, other shareholders in the company. Is there an active board of directors?
Okay. Currently, we have an advisory board that is a non-paid, obviously. We've used that for key responsibilities. We will be developing a board of directors as we move forward with this Series A, and we anticipate at least 2 board seats with this Series A round. Including myself and Don for 2 other, and then we'll vote in an independent board seat also that we want to add in. So we will formalize as we move forward. We did not put a formal board of directors together yet because of the potential for funding and making sure that we had adequate spots.
Great. Then there's a question from the audience. Series A1, is it 3 million or 8 million?
It's 3 million.
Okay.
3 million. That will.
You talk a little bit more about your fundraise and what the use of the funds are.
Okay, so currently we're in fundraising, and we are working speaking with several angels and private equity and various groups to work with fundraising and to try to bring in, and we've expanded into shares, and we are moving forward aggressively, because the faster we can get that $3 million, the faster we can get toward patients. And so that's really critical.
Great. Sarah, did you have one more question?
Vadim, how soon after the raising of the 3 million, how soon will you be needing to raise the A2 of 7 million?
So I'll take that one. So we already have the CRO set up to do the toxicity in the rat, and they're within a month or 2 out. It'll take us 3 months to make the drug. We know that, and it'll take us about 3 to or probably 5 months to do the toxicity. After that, just writing up the IND and the FDA only takes a month to approve it, and they have to get it to you within 4 weeks. We expect to raise money after we get the rat tox to show there's no toxicity at that point to raise the second Series A2 funds.
It will be very close after. We'll that first 10 million, it's going to be an ongoing process, and then it will slow down a bit.
Understood.
And one final question from the chat box is, how large are the tranches in Series 1, i.e. smallest investment amount by an investor?
Smallest investment is $25,000 that we're working on.
Okay, great. Well, I think that brings us to the end of our time. Thank you, guys. And with that, we'll go
Thank you.
ahead and bring off our final presenter. We'll have Jordan Wilson of SAPS come up and talk about his consumer product good.
Good. Wow, some really cool business models today. I've enjoyed listening to what y'all have to say. So thank you for having me here, and thank you for letting me be a part of this. I'm Jordan Wilson. I'm the CEO of SAPS. We're a drink for sports and everything else. So I'm going to get into what that means. So what is SAPS? SAPS is a better for you, cleaner hydration product, better than anything else in the market. What you may not know is that 80% of Americans are dehydrated, and their healthy options to fix that are pretty limited right now. You may walk down the grocery aisle and notice there's a lot of options out there right now, but those things are filled with tons of sugar, unhealthy ingredients, or they just don't really work. To kind of paint a picture, so when Gatorade was first created, it was purely built on function back in the 60s. Now their formula has 4 times the amount of sugar that it had when it was first created. So SAPS is really the answer to that problem. We've got 1,900 milligrams of electrolytes that are very balanced and have science to support that. We've got no added sugar, no artificial flavorings or colorings. We have other functional ingredients that all of us should be drinking more, supplementing more in our daily diet. So who is our customer? Normally I would show a video today, but our customer is really the physically and socially active individuals. These are people that are in their 20s to 40s who are looking for better for you products, and they want to take care of their body. They're the people that are grabbing stuff, turning it around, looking at the nutrition panel, and don't want all the crappy mass market stuff that our grocery stores and convenience stores are filled with. SAPS exists to help people do more, and that's exactly what our customer wants. So whether it's going for a long run, after you get off work, waking up dehydrated from a long night before, or just wanting to feel at their best during the workday, SAPS can help with all of that. So looking across kind of the landscape here, you can see there's just a ton of crappy products out there. You've got a lot of added sugar, high calories amount, low electrolytes, artificial flavorings and colorings, and bulky plastic bottles. So what's actually in our can? So 80% of this is just coconut powder. We're pulling out natural vitamins, minerals, and our natural sugar from that. But beyond that, we've got functional adaptogens in there for inflammation and mental wellness. We have other natural ingredients for muscle recovery, for immunity, and for liver detox. Lastly, we use the best natural sweetener in the world, monk fruit. It's technically a superfood, and it doesn't have any downside effects that other sweeteners have in this space. We've sampled probably 5,000 people to date. These are the bullet points that are really resonating with people and what we've seen work. So 1,900 milligrams of electrolytes, like I already said, that's 5 times your standard sports drink. There's no added sugar, 35 calories, no artificial flavors and colorings. And last but not least, we're Whole Foods compliant. There's only one other hydration drink in the space that is actually Whole Foods compliant. And that means that's a big thing. That's a stamp of approval for a really clean, better for you product. So how about the market? Last year, customers were surveyed on what is the #1 priority for what they're looking for in a beverage. And hydration was the #1 thing. Yes, we've seen kind of success stories in this space. We've had Body Armor come on the space, recently Prime. But people are still looking for more hydration and other functional benefits. Analysts expect this to double, almost double by 2030, and it's currently growing at 11% every single year. Strangely though, Gatorade still has 70% of market share. They've got kind of a lockdown on distribution, and I think it's time for somebody else to come in and disrupt this space even more. So our team is proven. I myself was part of another hydration brand for 3 years. While I was there, we grew from 1 million to 18 million in sales. My VP of sales was one of the founders of an alcohol company called Lone River Ranch Water. They were kind of a unicorn. They blew up within about 12 months and sold for $100 million to Diageo. If you go kind of across the board, we've got Brett and Lauren and Sean. They've all been a part of really early stage companies, either in alcohol or hydration, and been a part of that growth story. So our distributor progress to date, we launched in March with Benny Keith, who is a statewide powerhouse distributor here in Texas, and in April with Littman of Tennessee. This is the exact same blueprint that my VP of sales used to launch Ranch Water. And because these distributors are really good. Benny Keith is one of the largest Budweiser distributors in the country, and Littman's been around for a very long time. So where we're selling right now through those distributors is at Central Market. So Central Market's owned by H-E-B, kind of a higher end grocery store here in Texas. Neighborhood Goods, which is kind of a hipster, like younger person store. And then Gamma, which is independent C stores. What I'm most excited to tell you about, though, is where we're aiming to sell. So a couple of weeks ago, Whole Foods buyer reached out to us. Uncommon outside of kind of the buying cycles that these people have. They're taking notice. We're in talks with H-E-B right now, and our sales team expects that to land in the next couple of months. We just got a test run with 7-Eleven in Tennessee, which will lead to hundreds of stores if that goes successfully. We're actually reviewing the brand with Kroger right now. So our margin, currently we're selling this to our distributor at 39 points. Thanks to just volumes and having good relationships in the industry, we see a path forward to get this to 49 points selling to our distributor. So that's not even taken into account e-commerce margins, which are even better than our distributor. We're pricing on the shelf at $2.99. That is a great volume price point for a high-end, better for you product. What's been the most cool about this brand and how this is going to really work is through organic relationship building, partnering with the right people that are offering good experiences. So we haven't spent a dime on digital ads yet. We've generated 1.4 million online impressions on social media just through partnerships over the last 3 months. So we're working with people like Outdoor Voices, Recess Pickleball, All Day Running, which is a huge running community. And we're seeing that younger folks who are taking care of their body, want to get outside, be active, they're all resonating with this product because we're so different. We're so healthy. We're in a can. The packaging looks different. It doesn't look like your standard sports drink, which means that we can play in concert venues, in bars, and all kinds of places where Liquid Death really took off when they started in the water space. So the rest of this year, we're accelerating our sales velocity in Texas and Tennessee. We're planting our flag on H-E-B, and that's going to be our flagship account. For those that don't know, it's a huge grocery store chain here in Texas. A lot of people watch what they do, and we can move a lot of volume through them. Once we get these chain dominoes to fall, then we really start leveraging the distributor network that we have, who has hundreds of reps on the street hitting accounts every single day. We fully expect and know we're going to have to raise a Series A sometime next year, something that we want to have more traction this year before we go into raise our Series A for next year. So right now we're projecting to do 1.5 million this year, getting into about 2,000 accounts on the back half of this year. Really what we're excited about is next year. So the way a lot of buying cycles work is you present to buyers in September, October. Those shelf resets happen in January, February. So we're gearing up for massive growth next year and the following year, which fits our acquisition strategy. We know that being in the space for the last 5 years, if we can get to $20 million in 3 to 5 years, there's plenty of beverage conglomerates that would acquire a brand like that. We're currently using a safe round. We've raised $750 in the bank. I got another $250 committed a couple of weeks ago. We're capping it at 1.5. And we're using those funds for marketing. Obviously, it's a marketing heavy industry. We're using this on sales expenses and then just continuing to bolster our inventory to meet this demand. Thanks for your time. Do you have any questions?
Let's start with Vadim. Vadim, what's your first question?
I don't know. This is great. I have precious little experience, so maybe a stupid question. How do you, if you're successful in Texas and Tennessee, how do you jump from that to national, or do you at all jump from that to national distribution?
It's a great question. So we actually are refraining from trying to go national. That makes us more attractive to a national conglomerate. We plan on expanding kind of across the South in hot states. That's where more people are going to drink these products. And that's going to be largely chain driven. So for instance, Publix, huge chain store in the Southeast. If they want to bring our product in next year, that's going to drive expansion.
Sarah, what's your first question?
Hi, Jordan. Great job. Thanks for sharing more about SAPS. Love to learn more about the round. So congratulations on having half of it closed. I'm sure that feels good. What's the valuation, if it's a cap or if there's a discount on the safe? And then did you have a lead investor for the round? If so, who was that?
Yeah, great question. So currently our cap's at 10 million. We've primarily raised from high net worth individuals, some family offices. We've talked to a lot of VC groups in this space, and they've all kind of taken a pullback a little bit this last 6 months or so. So they're looking for more like Series A, that $2 to $3 million range. So we don't have particularly a lead. We just have high net worth individuals that know this space.
Thank
Great.
you.
Question from the audience. Do you have any third-party research validating your claim that SAPS is an efficacious hydration product? Or otherwise, what is your plan to defend your product health claims?
Great question. So we actually partly owned by a parent company called Kraft Health, who has a lot of doctors and nutritionists on staff. They poured in research and thoughts into this, along with myself, who have been in hydration for 3 years now. There's really just a lot of research that has gone into this. We don't have any sort of certifications or scientifically backed studies to support the different electrolytes that we have in this drink. But we know generally the average person loses 500 to 1,000 grams of salt for 30 minutes to an hour workout. We know what like the ratios are of what people lose in electrolytes, and so we're replacing those in a proper way to kind of match these different activities and how you lose nutrients.
Great. And there's one more question about HEB is still growing in North Texas. It looks like there's 7 million in DFW, but they only have one store at the time. It looks like there may be more expansion coming there.
Yeah, no, that's they did a big deal actually with Kroger a long time ago and said, basically, we won't expand into North Texas if you don't come down to Houston. And Kroger just buffed that handshake deal a few years ago. So I think HEB is about to go take them out.
Okay. Well, the last question on the chat is, what does the taste like?
So it tastes like a saltier Gatorade. My father-in-law and older folks, like they used to love the taste of Gatorade. It's a little bit saltier in the past. The new formula doesn't taste like that at all. So it has very similar taste profile, a little bit salty, still a little bit of sweetness. I prefer lemon lime, but we've got 3 different flavors right now that kind of touch on the salty sweet spectrum.
Great. Vadim or Sarah, you have one more question for us?
You mentioned that you will be relevant for a takeout when you hit $20 million in revenues. How long do you think until you hit $20 million?
I legit think 3 to 5 years. I was a part of another hydration brand that did that. We did it in 3 years. We've got other people on the team that have achieved similar results. You have to get through the early hump of kind of what we're doing right now. So getting chains, raising money, driving brand awareness. But we've got the team to do it.
It's a rhetorical question, but why do healthy hydration drinks sell for a couple of $100 million and tequila companies sell for a couple of billion? It's a rhetorical question. Don't answer.
We do have one question from the chat box again. Any thoughts on aligning with sports franchises?
Yeah, I think it can make a ton of sense for us. A lot of the like mainstream standard sports teams, they already have contracts locked down with Coke and Pepsi. So really hard to tap into. We're kind of looking for those alternative things. So we actually are doing stuff with the UT lacrosse team here in Austin. We're doing a lot of stuff with marathons and runners, really things that the Cokes and the Pepsis of the world haven't tapped into yet.
Great. And Sarah, any final question there?
No, I'll leave the 10-second clock. I see we're in the red zone, but thank you so much, Jordan, for everything you said. I'm going to go to my local Central Market and see if I can test them out. So thanks for sharing today.
I'm happy to send anybody samples too. If anybody wants it, Martin, you can, or Hall, you can send out my email and I'm happy to send out some samples.
Great. We'll poll the audience there on that. I want to thank everybody for great questions on this one. Thanks, Jordan. Thanks. And then thank our panelists, Sarah and Vadim. Thanks for great questions on this panel. We're at the end of our time. I want to thank everybody for joining us there. Those in the audience, we've given you a chance to ask questions and identify with the poll. If you have further questions, feel free to reach out to us and we'll connect you with any of the companies that we're presenting today. And with that, we'll go and close it out and we'll hope to see you guys again next time. Thanks so much for coming and appreciate all the work you guys do. And thank you for the audience as well for joining and asking great questions. With that, we'll go ahead and finish it up and we'll see you guys.
Thank you.
You all.
Thanks.